When the Federal Reserve decided not to raise rates 2 weeks ago, developed markets went down. The brief rally in emerging markets was soon snuffed out. Then when Fed Chair Janet Yellen last week said that rates might go up, after all, markets briefly rallied, but they're now down again. Perhaps the markets just want to go down. Well, so far the scale of fear in developed markets actually remains fairly controlled. The S&P 500's off just over 1/10 from the summer peak, which puts it only just in correction territory. It may feel like Mine-ageddon to investors in Glencore, while Volkswagen shareholders are choking. The DAX has plunged almost a quarter. But overall, developed equities have lost only 13% from their peak. The question is whether this is the beginning of something much, much worse. There are good reasons for caution. As the problems of emerging markets intensify, the power of central banks to generate inflation seems to be waning. There are lots of measures of risk which have come back up to levels not seen since the Eurozone crisis abated in 2012. Equally, there are reasons for hope. One of those is that the gloom might be overdone. Economies are next to impossible to forecast correctly, and any signs that Western economic growth has stayed reasonably steady, that China's not imploding just yet, or that Abenomics is working in Japan might well prompt a big rebound after the speed of the falls we've had recently. Another possible reason for hope is that maybe what shares have done was just a delayed reaction to bad news that was already priced into the bond markets. In other words, it's already been done. Investment-grade bonds have been struggling for more than a year, with the spread over comparable government bonds widening drastically to more than 2.1 percentage points for BAA-rated bonds. That's the highest since 2012. You can see on here the overall spread, measure Barclays index called the US aggregate, the corporate sector of that. This is basically a measure of risk. The higher it is, the worse things are. So the higher the yield, additional yield, that investors demand above government bonds. And that's really come up very rapidly from the lows in summer last year. The question is, are the bondholders showing more sense than shareholders? Well, bondholders like to think so, but it isn't always the case. You can see if you look the difference here, I've got the S&P 500 in blue. You can see that these two move in pretty much opposite directions for most of the last 5 years. Most of these patterns are exactly the inverse of the peaks. Now, the comparison isn't quite perfect between these two because, of course, some of the S&P 500 is junk rated and so doesn't appear in this investment grade measure, and some of the investment grade bonds are of companies which aren't in the S&P. But over the past 5 years, the two have tended to move in opposite directions, and you really ought to expect that. When investors feel confident about taking risk, they're happier buying shares, and at the same time they demand a lower spread in order to buy corporate bonds. Broadly speaking, they're happier with risk. Now, over the past year, these two measures separated really quite significantly. Investors became uncomfortable with the bonds, so the spreads rose. That was over this period here, but shares first went up and then stayed steady in a very, very tight range. They then suddenly corrected after the Chinese devaluation, while bond spreads really rose a little bit during that correction, but not particularly much more given the scale of the move that had been underway over the past couple of months. Now, this link isn't just between the lines on a chart. Corporate treasurers have been arbitraging the gap between the cost of bonds and the immediate cost of equity, measured via the earnings yield, since the recovery from the crisis began. They do that by borrowing in order to buy back stock. The supposed benefit of the arbitrage, that's measured by the gap between the two, has approximately halved since 2012, thanks to a combination of the rising valuation of shares and the rising bond yield, although it still remains worthwhile for finance directors who are focused purely on the short term. The combination of buybacks and the rise in takeover activity back to pre-financial crisis levels makes it riskier to lend money to companies, because those companies, broadly speaking, have more debt, means they're less appealing to lend to. And so you get this rise in spreads that we've seen. Now, it isn't necessarily the case that shares should fall just because the companies are riskier. So long as investors are optimistic about the outlook, then extra gearing might be seen as a good thing, as it should boost profits. As soon as sentiment turns sour, of course, that gearing starts to accelerate on the downside. It really hurts. And shareholders might notice, for example, that S&P 500 sales and earnings per share have been falling recently in spite of all those buybacks.